Welcome back to Explain the Charts. It is April 13th, 2026, and today we are looking at the USDJPY currency pair, which is currently at a major crossroads. The pair is trading near 159.39 as we enter the middle of April, reflecting a market that is tense and highly reactive to global headlines. Before we look at the price action, we have to talk about the massive geopolitical shifts happening in the Middle East. Recent reports indicate that US-Iran peace talks have failed, which has immediately boosted crude oil prices and reignited inflation fears. This is a double-edged sword for USDJPY, as the Japanese yen is notoriously vulnerable to energy price shocks, while the US dollar is finding safe haven demand. Furthermore, we have seen Japanese officials stepping up their verbal intervention as the price approaches the 160.00 psychological barrier. This level has acted as a ceiling throughout much of 2025 and 2026, and the market is sensing a potential change in the BOJ's patience. On the U.S. side, the Fed remains relatively hawkish, though recent existing home sales data came in lower than expected at 3.98. This cooling in the housing sector might suggest that the Fed's aggressive rates are finally biting, which could eventually cap the dollar's strength. However, with the 10-year yield differential still favoring the U.S., the fundamental backdrop remains technically bullish for now. Looking at the daily chart for USDJPY, we can see the broader trend has been consistently bullish, moving from the 140s last year to the current 159 range. Note the series of higher lows throughout early 2026, specifically the bounce we saw in late January near 152.43. From that point, the market reclaimed the 155 level and hasn't looked back, using it as a springboard to challenge the all-time highs. We are currently seeing a cluster of candles around 159, which represents a period of intense consolidation. This sideways movement is happening right under the 160.28 high we saw back on March 27, 2026. When a market consolidates near a major high, it usually suggests either a breakout or a double-top reversal is imminent. The daily candles show long wicks on the upper side, indicating that sellers are defending the 160 handle with significant force. If the daily close can stay above 158.20, the bullish bias remains intact despite the volatility. This 158.20 level is crucial because it aligns with the 200-period EMA mentioned in recent FX Street reports. A daily close below that level would be our first signal that a deeper correction back toward 155 is on the table. Let's drop down to the 1-hour chart to see the intraday behavior during that late March climb. On March 24th, we saw the pair trading around 158.60 before a steady leg up took it into the 159s. Between March 25th and March 26th, the market showed a stair-stepping pattern, with each small dip being bought up aggressively. You can see the transition from the 159.20 level to 159.60 was quite rapid on March 26th. This suggests that liquidity was thin above 159, likely due to stops being triggered as the pair neared the 160 level. The peak on March 27th reached 159.94, almost touching the 160 line before the verbal intervention headlines hit. Notice the subsequent drift back down toward the 159.40 support after that peak. The 1-hour chart shows that the 159.40 area has flipped from resistance into a minor support zone. We want to see the hourly candles maintain this level to prove that buyers are still willing to enter at these elevated prices. If we lose 159.40 on the hourly, the next stop is likely the 158.80 region, where we saw significant volume earlier in the week. Zooming in even further to the 15-minute chart, we can see the micro-volatility during the last few trading days. Look at the action on April 8th, where the price dipped below 158.50 briefly before a sharp reversal back to 159. This kind of V-shaped recovery on a lower time frame often signals strong institutional buying demand. On April 9th, the pair pushed as high as 159.29, but each attempt to break 159.30 was met with selling pressure. This correlates with the news that Japanese officials are closely watching the market for disorderly moves. The price action on the 10th showed a very tight range, fluctuating between 159.10 and 159.25. Low volatility on a small time frame often precedes a major breakout once the U.S. session liquidity enters the market. We are looking for a definitive 15-minute close above 159.45 to confirm the next impulsive move higher. Conversely, if we see a breakdown through 158.90 on this chart, it confirms that short-term momentum has shifted to the downside. The 15-minute chart is where you'll see the first signs of the intervention if the BOJ decides to actually enter the market. Now, let's look at the reasons to be bullish versus bearish on this pair. The bullish case is driven by the interest rate gap. As long as the Fed stays hawkish and the BOJ remains cautious, USDJPY wants to move up. The geopolitical premium from the Iran crisis is also adding a layer of support for the US dollar as a safe haven. Technically, the long-term trend is up, and we are simply consolidating near the highs, which is a sign of strength, not weakness. On the bearish side, we have the intervention wall at 160.00, where the Japanese government might sell dollars to protect their currency. There is also a growing sentiment that the U.S. economy is slowing, as seen in the home sales data, which could lead to a peak dollar narrative. From a technical perspective, a failure to break 160.28 could create a massive double-top formation, leading to a multi-month reversal. You should look for a clear break of either 160.30 to the upside or 158.20 to the downside for the next major swing trade. Until one of those levels gives way, we are likely to see choppy, range-bound trading between these 2 points. Keep a close eye on the US PPI and jobless claims coming up this week, as they will be the primary drivers of volatility. To recap the important price levels, resistance is firmly at 160.00 and 160.28. Support sits at 158.20, with a deeper psychological level at 155.00 if things get ugly. My unbiased prediction: there is a 60% chance we see a breakout above 160.30 if the Iran crisis escalates and oil prices stay high. However, there is a 40% chance of a sharp 200 pip drop if the BOJ intervenes or if U.S. inflation data comes in surprisingly soft. Conditions that would reinforce a move higher include a hawkish speech from Fed officials Goolsbee or Barr later this week. Conditions that would reinforce a move lower include a sudden resolution to the Iran-Lebanon conflicts, which would lower the inflation premium. Look for volume spikes at the 160.00 handle, as that is where the liquidity pockets are currently sitting. Remember to watch the news calendar for the Japanese revised industrial production figures as well. This is a high-stakes environment, so keep your stop losses tight and respect the 160.00 psychological barrier. This video is not financial advice, so please do your own research before making any investment decisions. Good luck out there.